So we actually got a lot of questions, Marion. So I think it'd be
Okay,
kind of cool
great.
to,
Okay.
instead of us freewheeling it,
Okay.
we'll just interesting. Some of them have the same tone. It seems like there's not a large gap of what people would like to discuss, or the same types of frustrations. Um, so I'm gonna start out with the most obvious one.
Okay.
I think. And
That's
what I'll
good.
do is I'll just type them in this way. Everybody can see them, and if anybody wants to comment on them while we're talking, um, absolutely participate. Definitely the biggest thing to get out of this. You're going to show up, get off. Don't be a wallflower. Participate. So
And
this
not only
this
that, if people come in late, they can see what question we're talking about. So I think that's a great idea.
right, exactly. Hey Joan, how's it going?
Hi, Joan.
So first one we have here, which is a familiar tone running through the responses, and we intentionally worded what's the most frustrating part. Not following my plan. I guess it's actually good that it was implied that you actually have a plan in the first place.
I was just going to say that. Excellent. You have a plan. So many people come into the day without a plan. So whoever wrote this, I applaud you for at least having a plan.
So I guess that really gets to the question though of not following the plan. Why do you think people don't? Why do you think somebody would go through the hassle? And actually, hassle is not the right word. All of the work that goes into actually putting one together. And let's define a plan: a strategy, entry and exit signals, and money management. We'll keep it as simple as that little trifecta. Why would somebody go through all the work that's necessary to do that and then not follow it?
Because I think they can either think they won't lose as much or they can make more by not following the plan. Oh, I had a plan to get, to get out at this, maybe up at resistance. They're long and they're going to get out at resistance and they go, oh boy, it looks good here. Let me get in. Let me stay in. Now, something like that, what I do is I'll get out of some of mine. I will hold some, but I am following my plan, but maybe I have other shares that aren't, I rethought my plan. But I do think you have to get out of some of it, if that's your plan. How about you?
Well, first, I agree. I definitely applaud somebody for at least saying, "Why am I not following it?" That's definitely, the fact that they can definitely imply that they have one is phenomenal. I mean, I will flat out tell you, and again, I was in the prop trading world for a long time. Most people do not have one. They don't take the time to do it. And
Right.
again, part of it was how you got taught back then. You essentially would be given be giving an account, and basically people were like, all right, there's the key, go and figure it out, which is
Mm.
a little ridiculous, but that's how it was back then. But I have to be honest, I think some people, if you find yourself having a hard time following a plan, I think you're not thinking through what the point of the plan is in the first place, which is long term. How can I word it? Long term odds following through over a large sample. If you're not following it, that means you're not making a commitment to believe that you actually have an edge that will follow through. And you tend to start to jump around from idea to idea that's not necessarily in your plan. I mean, the entire point of having a plan is getting to the point where you say, this is exactly my edge, and I'm not going to do anything else. And sometimes we get to the point where you're afraid of missing out on other opportunities,
Right.
which is understandable, but that actually is going to lead into the next question. And I think what I'm going to do, instead of we're going to type them into the box, but I'm also going to put them on the screen. I'm going to make that the screen we're going to look at instead.
Okay.
This way, anybody can kind of like flip through the video later, and like pull up that one particular question. So I'm actually going to, if you can just give me 1 second, I'm going to pop that in there.
Okay. And Joan says fear, which I agree, especially if you're in a losing trade.
But is that following the plan? That's implying you're already in the trade.
Oh, see, I thought they meant they're in the trade and they're not following their plan to get out.
Oh, I guess we could address both.
Okay.
There's no reason. Yeah, I guess there's no
Yeah.
reason not to.
Okay. So we looked at it from two different sides. I'm looking, they're getting in, but they're not getting out. And maybe because they're not getting out because, okay, now it's, I thought if it cracks this level, I'm out. Oh, well, wait a minute. Maybe it's holding here. And the same way with when they're at resistance, I'm not going to get out because it appears resistance. But if you can think of it this way, all of a sudden your profit potential has gone down when you get up to resistance where you're going to get out. So you always want to have the edge. You always want to have the biggest profit potential. And if you could think about it as, okay, it's up here, it could go higher, and yes, it could. But all of a sudden, your profit potential is down from where you originally bought it.
I agree. Let's actually expand a little bit on, can everybody see the screen, by the way? I just want, because I think this could be a kind of a cool way to do it. Where I have the PowerPoint up with the questions.
Yep, I can see it.
Okay, terrific. So I guess, look, I think every trader at some point has gone through a period where fear has seeped into their thought process, either before a trade or after a trade, and I think with fear also goes hesitation. Afraid of getting into a trade, but then hesitating on putting on a trade, which that might be a little bit of fear of losing money, but then hesitating to get out of a trade or hesitating to put on a new trade. What are you actually afraid of? And again, excellent question, because we've all done it. There's not a question. Every single person has gone through it, and especially, we even talked about it in the game plan meeting a little bit the other day about increasing share size and how that always affects. You're trading well. And you're like, well, if I'm doing it good on X amount of shares, if I size up, that means multiples of what I'm making. And in my experience, everybody loses money when they start to size up, just because mentally it's a different level of risk that you're taking per trade. But I think, from a fear perspective, are you afraid? There's three things. Are you afraid of losing money? Are you afraid you don't know what's going to happen next? Or are you afraid you don't trust yourself to do what you're supposed to? That last one, I think, is a much deeper rooted thing that a lot of people don't want to admit. Because let's face it, if you have an account, you obviously are okay with accepting and taking risk because you have the account in the first place and you're looking to put a trade on. So if you're afraid of losing money, and that's a real fear, you should either scale back on your share size dramatically so you're not afraid and you just trade the structure of the trade. But if you're afraid of what's going to happen next, meaning you don't know what's going to happen next, you're afraid if you put on a trade it's not going to work out, then you need to get a little deeper into the psychology of probabilities and probabilities over time. Because, and again, a lot of this ties back to trading plan and that kind of stuff. The light bulb, all the above, good. That's the whole point of us discussing it, right? The light bulb really goes off when you take the time to say, this is my edge. I don't care about anything else that's going on in the market. I either believe in it or I don't. And obviously, we hope you would commit to say, I do, right?
Right.
Then getting to the point where you are only looking for trades that match your edge. So if you believe in your edge and you're only taking risk on your edge, there's really no fear. There shouldn't be any fear. And that's assuming you're okay with accepting risk on the trade. There shouldn't be any fear other than, do you trust yourself to follow your plan? And once you take that out of the equation, or I should say, here's how to take it out of the equation. Trusting yourself to follow your plan means you must believe in your strategy in the first place, which means that you're making the assumption to yourself, I believe this happens more often than not. And if I really, really believe that, there is never a reason for me to hesitate because I believe this happens over time. So I need to take every single trade and then trust myself to follow my risk management. So assuming you can get away from being afraid of losing money, which you have to get over that if you're going to trade. And if the P&L is a little bit too much for you, you have to cut down on your share size and give yourself a chance to actually get to the point where you're like, I'm going to follow the structure of the trade based on my strategy. Then you get to the point where you pull yourself away from saying, I don't need to predict what's going to happen next. I need to know what's probably going to happen next. That's the whole point of having a strategy, because let's face it, how many of us have seen the perfect flag, the perfect breakout, the perfect anything, and it doesn't work out? That just happens once should be enough to tell you that everything perfect could work out, could line up, but still not follow through, which then take that out of the equation. There should be no fear of knowing what's going to happen next because nobody knows exactly what's going to happen next. It's what's probably going to happen next, but what am I definitely going to do? That's how I got over fear. When I admitted and got to that point where, okay, I'm not afraid to risk money, I'm not afraid to take risk. If I have a plan that I believe in, then the last part is remove from the equation predicting what's going to happen next. I just have to trust myself. And you know what's interesting, Marion? Trusting yourself really boils down to, can I follow my plan because I believe it works. And if you believe it works, there's never a reason not to put on every trade that matches your strategy, and you should never hesitate to get in or out, because now you're thinking, okay, how does this work over 10 trades, 50 trades, 100 trades? Then, that's kind of an advanced thing, but we talk about it often. When do you get to the point when you're managing multiple positions? And if you're trading well and your strategy dictates more than one trade, take both of them if you can afford to. Learn how to allow your probabilities to play themselves out. So, Joan, it's those three things, and let's assume we get past fear of losing money. If it's fear of losing money, scale down a little bit. If it's your strategy and you believe in it, and you get it to the next point where you're afraid you don't know what's going to happen next, stop that. You don't need to know what's going to happen next. You only need to know what you're going to do next. And then the last part, obviously, is just following it flawlessly. So all that came out of one simple question.
Okay, can I actually address something else?
Sure.
Maybe part of the problem is the game planning itself. And we often talk about this in the morning. Does this look like a buy? Yeah, it looks like a great buy, but it's not a good buy now. Or the probability of you making a decent amount of money on it is very low because maybe it'll hit resistance in 20 cents. So really game planning and taking away the trades that aren't the best probability and only looking at the ones that have a good profit potential and a better potential of working out. So maybe part of it is in the game planning itself.
Yeah, we discussed that quite a bit during the morning, and the terminology we use in the game plan meetings, we say you have to have a progression of awesome trades and then everything else that's not an awesome trade. And as a trader, you have to learn to make that decision. Reducing share size is not making it a better trade on a bad idea. It's still a bad idea, but we've all done that at one point. But you're absolutely right. Your game planning has to have some distinction in there where you say, if I lose money, I'm only losing money on my best ideas.
Right, so fine-tune the game plan. Come join us in the mornings because that's what we do in the morning. We pick out the best trades for the day.
Yeah, and look, even obviously it's a membership room and people are paying to be in the room, but the bottom line is we're not shy about saying it's hard to find a great idea today and don't do anything. That's what a real trader does.
Right. And there's been other days when we said, oh my gosh, there's so many possibilities out there.
Yep. Very stock specific lately, but there's been some good ideas. But you have to really, if you don't have a progression of what a great trade looks like, if you don't have a great trade and what it looks like, everything looks the same to you.
Right.
So you need to know what an awesome trade looks like. And again, we could even take that a step further. Is it a good trade versus is it a good trade now? Not always the same. Like, for example, we're talking about Facebook today, which has had a pretty good run to the upside for 3 days. Is a higher opening in a stock that's that strong 3 days in a row the greatest trade? What's the profit potential up in that level? So very, very clear that it's got to get up there. So the next question here, it takes a lot of time and work to make some money, and then one bad day can ruin it all. I would even take it a step further and say one trade can ruin it all.
Agreed.
I've seen, well, actually, I'll be honest, I've done it. I've done it at some point in my career. Yep, Mitch, definitely a game plan. How do you get past the potential for making money 6, 7, 8 days in a row and then giving it all back on one day? How do you get past that, Marion?
I think we just addressed it. By if there's a day when nothing is going on, when what I used to call I was really great at inventing trades, there was nothing going on, I would see something and convince myself I should be in it. Now I just walk away. I've actually not done much this morning. I did a lot yesterday, did really well yesterday. This morning I even said to Pete, I don't really see anything. I'm flat now. By what time was it? 10:15. I was flat. And I think that's part of the problem. We're not going to make money every day. We're also not going to be able to see trades. I say see and be able to find really good trades. And maybe I wasn't looking in the right places this morning. I got out of my Netflix and I said, I'm not getting back in. It's too whippy. I'm not going to lose my money. And the other point of that is, I think part of it is not recognizing it's a bad trade and getting out of it really quickly, or really trying to hold on to it because you really, really want it to work out.
Well, actually, that was really the area that I was going to go down. Most big losing trades is us not admitting it's not working out, and for some reason having an emotional attachment that I did all of this work, or I'm right, the market's wrong, that kind of thing. And you could probably look over at anybody else's screen and say, what are you doing? The trade's clearly not working out. The trade is clearly moving against you. Get out of the trade. And we've gone over the stories where with prop traders that would literally be sitting in the software would stop them from placing another trade when they hit their daily limit. But for some reason, they will sit in a losing trade, continue to lose money just so they don't have to get out of the position. You have to think long term with your business. You have to think of your cash as your inventory. And if you're just letting your cash rot in the back and getting worse and worse and worse, you're not going to have a business. You have to think long term, and taking losses on trades, and especially preventing one big blow up, you have to think long term if you want to be in the business. The story that I used to use all the time when I was doing seminars, I would say, I'm in a losing trade and I'm sitting here, and by golly, I have to hold this losing trade because I am never, ever going to have another opportunity to make money. So I have to hold this losing one. It even sounds stupid saying it. That if you're saying to you, oh, I can't get out of this trade. I'm never going to find another winning trade. What am I doing? But we do it anyway. But how do you stay away from the blow up? The blow up is you have to think long term and accept whatever dollar amount you're willing to risk before the trade. Come heck or high water, if it hits the number, get out flawlessly and reevaluate. And even to take that a step further, and I know we discussed this a lot in the game plan meetings because it's a big topic, trade management. There's nothing wrong with cutting back your share size on a trade that you still like. There's no golden rule that says, darn it, I said before the trade I'm willing to lose $1,000, and I'm sitting in this trade until I lose $1,000. There's no golden rule that says that. Whoever thinks that is, you're reading the wrong books. If you have 1,000 shares and it's not working out, scale it back. You don't have to blow your day up or your week or your month on one trade that I'm right, the market's wrong, and I'm just going to hold on to it.
Also, you can get out, and if you still believe it's a good idea, wait. If Netflix happened, that happened with Netflix the other day. Netflix, right, maybe in the first 45 minutes, had an impulse down. You could get out of it, but you know what? Watch. Get back in it. You can get back in it, even if you've gotten out of it once. Don't get in it for revenge trading, but wait for the good trade. If it's still a good trade, it will be a good trade an hour later, and maybe it will correct itself. So get out of it and wait for the next opportunity to get back in it.
Yep, and even taking that a step further, getting stopped out doesn't invalidate the idea anymore. It just means that trade got stopped out. Wow. If you get stopped out of a trade, or even if you make a winning trade, you don't have to immediately go to a different stock. I mean, maybe you might want to scan around to see if anything else is setting up, but you have to make sure if that stock is quote unquote doing what it's supposed to do today, stay there. It's giving you money. If it's doing what it's supposed to do, don't leave it. You don't have to be so inclined to be like, all right, I'm done with that stock at 10 o'clock in the morning. No, it doesn't wear out. If there's institutional buying pressure or selling pressure in that stock, stay there. Join them.
And if you got out too early and it's still strong, get back in.
Yeah, exactly. Yeah, that's a big thing too, getting out of trades too early. Next one we have not having the freedom/capital to trade bigger. The obvious answer is number one is you can definitely get your licenses and become a proprietary trader. If anybody is interested in that, I have been around a while. I could definitely make a suggestion on that. But I think I'm going to tackle this from a little bit different perspective. This is really more of a trader who is not admitting where they're starting from, which will make it very difficult to succeed, because a part of the resources of trading, everybody just goes to right away that my only resource, what are your trading resources? Oh, how much money I have? No, well, there's experience, there's education, there's your risk tolerance, there's how many hours you could sit in front of a screen. But not having the freedom and the capital to trade bigger, that's like saying, I own a deli, but I'd really love to own Peter Luger's. If you don't have the money to run a bigger business, you can't do anything about it other than either raise capital through profits or actually get your licenses to trade. So don't try and trade above your resources, because you will start to push trades that are going to be very uncomfortable. And getting back to the last part, which is, you can end up wiping your account out by leveraging yourself too much. Leverage is a great thing as long as you understand how to use it and when to use it. But if this trader was sitting in front of me and we're having a conversation, not having the freedom to trade bigger, first of all, you should trade bigger because you have a track record that says you know what you're doing. And again, let's even throw a caveat out there. What would you say, Marion? Let's say you're mentoring a new trader, and they say to you, "I want to trade bigger," and you said to them, "Well, I need to see profits for X amount of time before I would recommend trading bigger." What would you say to them?
3 months.
Exactly the number that I use. I'm
Oh,
like, well,
really?
yeah, well, businesses report quarterly. I mean,
Right.
give
That's
yourself,
exactly how I did it. I was thinking
yeah,
quarterly.
give yourself a chance to not. And again, I've seen this 100 times. Oh, I had a good day yesterday. I want to start. I want to go from 300 shares to 1,000. That one day doesn't mean anything. You need to show. You need a track record to show that your trading business should trade bigger. And again, the metaphor I use all the time is like, oh, I had a good day yesterday. I'm going to triple the size of my office. I'm going to go sign a new lease. It doesn't work that way. Freedom to trade bigger comes with a bigger responsibility, but you need the experience, resources to trade bigger, and you need the track record to trade bigger. So don't want to trade bigger just because you want to. You should trade bigger or want to trade bigger because you have a track record that is validated with real trades, which actually takes me into another avenue, which is one of my biggest pet peeves by a mile, which is never build a sense of self-confidence in your trading ability based on backtesting or based on paper trading. They mean nothing. Absolutely nothing. You don't know anything about real market fills. You don't know anything about market conditions and how you're going to react. Absolutely need to trade. I don't care if it's 100 shares. Trade your strategy live for at least 3 months to see if it's valid, number one, and number two, whether or not you can follow it. So don't worry about trading bigger. When you should trade bigger, you'll know. There's not even a question about that. If anybody has any comments, questions, please don't let us talk over you. This is all about everybody communicating with each other here. Next, we have so many different methodologies. It's difficult to find a style that resonates with your personality. What do you think about that?
Oh, that's a tough one for me.
Yeah, that's why I gave it to you.
Thank you. Um, I don't know. Maybe the writer doesn't. Maybe it really hasn't understood what they're looking for in a trade, and how to read a chart, because I'm not sure what they mean by resonate with the personality. Is a personality that they're like an A-type personality, or I'm a little lost on this one.
I would think maybe they might be talking about, getting back to what we had said before about scalping versus swing trade. What's your,
Oh, I see. Oh,
what's the personality that you would prefer to like?
would they rather scalp or be like a day trader or a swing trader?
Right, exactly.
Ah, wow.
I guess if I was to answer this truthfully, I would say that it first off, it takes a little bit of time to get to the point where you're probably going to test a few methodologies with real money. That's assuming you didn't do research where you said I'm gonna do the research and I'm gonna try something first. But look, you could trade a few years ago there was a very big divided line between no, I trade Nasdaq versus I trade listed stocks. So that's one methodology right there in the beginning as well. But then you have scalping, you have momentum, you have bid ask trading, level 2 trading, then you have moving average. There's so many different ways to do it. Really, the only answer is you have to get to the point where you feel you've researched and tried enough that matches the way you look at the market, and then you just flat out have to trade it with low shares until you prove either it matches what you want to accomplish or it doesn't, and then you have to stick to it. So I guess this is kind of like a side part to this question, though. You eventually have to commit to one. The story that I've heard all the time is, if you're constantly changing your strategy, and let's say you're trading for a year, and this might not be the greatest example in the world, but Tiger Woods is going through this right now where, he's had so many different styles of swinging. He really doesn't have, the last 10 years of experience. He's got like 3 different 2-year experiences or, whatever. So you have to eventually stick to one, really, really let it play out. But look, the bottom line is nobody's going to hand you a strategy that matches you personally. You have to do some work. So get in there and, get some dirt under your fingernails and dig it out.
And maybe they're referring to what they watch, like if they watch the MACD, do they do candlesticks? Do they, are they watching the RSI Bollinger Bands? And what type of analysis they do?
Could be.
Which I would say.
It's a little bit general, but we can see this from multiple ways. My quick answer would be you have to do the research and eventually try one that you feel comfortable with. And look, if you're going to buy trading education, you have to buy trading education that teaches you strategies and then ultimately adapt that to your own personality and resources.
I mean, look what Al's saying. You know many, and they all work. Then what? Hey, Al, could you kind of clarify that? Do you know many like strategies or different types of analysis, or are you referring to like day trading, swing trading, momentum trading?
Well, I could give a little bit to that as well. I mean, let's say there are, which we all know, there's many strategies, there's many different trading plans, there's many different ways to attack the market, and then we could even take it further and say there's options, futures, forex, equities, right? Well, let's get back to what the previous question was, or the previous, how much money do you have to run multiple businesses? You don't, you have to take into consideration, do I have enough business to run multiple strategies? I mean, McDonald's sells McDonald's stuff. Starbucks sells Starbucks stuff. They're not, McDonald's is not selling, other stuff that's not food related. You only have a certain amount of limited capital to run your business. So there could be hundreds of different ways of attacking the market. You eventually have to say, this is how I'm running my store. So again, okay, Al, so whether it's momentum trading, swing trading, well, first of all, we want to make a distinction between short-term trading and longer-term trading. So I guess Marion, if we can make the distinction between strategy versus style of trading, and I think momentum, swing, scalp, those are more styles of trading than necessarily a strategy.
Right.
Sure. But because and the reason I say that is if you have multiple accounts with your shorter term account and your longer term account, obviously the way you look at them as far as letting trades fluctuate and that kind of thing, that's going to differ. So never mix time frames of this is my day trading account versus my swing trading account. But look, I'm very adamant about this. You have to be honest about how much money and experience you have to run multiple businesses. There's literally hundreds of different ways, if not thousands of different ways to attack the market. You most likely do not have enough money to run 10 different businesses at the same time. You most likely don't have the mental capacity to pay attention to all of those things at a time. And quite honestly, you probably don't want to. Pick something and be awesome at it. Own it. And say, this is the only thing that I do. And when this unfolds, I am going to make money or I am going to lose money. But this is what I am awesome at. Focus is everything. And look, I don't know what anybody's resources are here, but even if you have the money to do it, you still have a limited capacity to watch everything at the same time. And quite honestly, if you don't have a track record in the first place to say, I am good enough that I could run multiple businesses in the trading world at the same time, stick to one, print money or do really well in the one that you are committing to, and then decide to look for something else. But you have to think about your trading as a business. And how many different trading businesses can you run at the same time? It's very difficult. I don't know a lot of people. And again, we're talking about, I saw the guy on CNBC. Well, you know what? That's like me saying I'm going to go to a baseball game and and again, that I'm going to be a professional because I watched a game. That doesn't work that way. What can you do with your resources? Commit to running one business, get that one business running successfully, whatever that strategy or style is, and then expand. So don't worry about how many different ones there are. Which one are you running? Have you committed to? And are you making money with that one? And let's face it, if you're not making money with the one, you have to decide, are you trading bad? Is it really tough market conditions? Or is your edge just not a good edge? Maybe it was a good edge and it's not working now. So you have to, sometimes you have to get to that distinction where it's, it's either it's the market that's just really difficult and it's hard to find stuff to trade, or maybe your edge isn't working anymore, and then you got to go back to the drawing board. But you know what? We became traders to have freedom, so you got to do a little extra work. If something's not working, you got to really nail it down, and that's where a trading journal comes in.
And also, I think if you're using too many strategies, you're going to get paralyzed. Pete and I often talk about this. I use very little in my analysis. I use candlestick patterns. I use the 20 and 50-day moving average. I watch volume and volatility, and that's all I watch. I don't watch Bollinger Bands. I don't watch the MACD. I don't watch RSI. There's too much. Everything will negate the other one. I mean, there's too much to negate it, and so many of them are lagging indicators. It's not going to give you the edge. It's just going to make you think a lot more and give your brain a lot less time to develop your own personal strategy. Now, somebody can use something else if they want, but it's what you can understand, what makes sense to you, what resonates with you to understand where this market is going, where that particular stock is going.
Yeah, that kind of gets back to the other question about personality. But yeah, absolutely. Look, you could sit next to somebody else who's printing money. You have no idea how much went into how they're trading. You can definitely ask them the right questions. But if you're going to ask somebody else questions, you should be asking about strategy, not exactly what they're doing, because you want to eventually adapt it to what you're doing. Like, there's plenty of bigger traders that I've traded next to. And I'm like, wow, I could never take that amount of risk that they're taking, but they're comfortable with it.
Right.
Next one we have frustration is impatience and impulsive trading.
Right.
I know I personally got over this when I realized how much money it cost me.
Yeah, this is actually was probably the hardest thing for me to get over when I started trading on my own. Was like I said before, I would invent trades because I was bored. And now I know to walk away. But it does take time to realize, like Pete says, you're losing money. So if it's not your best idea of the day and it's not doing what you want it to do, sit on your hands, walk away. Pete goes play golf. I clean the house because I'm an A-type personality. No, or else I actually don't do that. I usually do something else in the market. I'll read because I'll keep an eye on the market itself. But I found that the most difficult and the most challenging part of my personality to get over. So what I would say is you have to recognize that you're losing a lot of money by doing it and saying, no, I said I was going to wait for it to break out over here, or we're going to wait for whatever indicator you had. And if it's not going to do that, you have to say to yourself, I'm going to lose money if I get into that. Yeah, sometimes you'll make money because it'll be a good trade, but 9 chances out of 10 you'll lose it.
I think impulsive trading is easy to explain, but why would somebody be impatient?
I found that's what I was. I was impatient when I was bored. Come on, I want to get a trade. I want to trade. I want
Why?
to.
Why would you be forcing? Why would you be forcing to look for a trade?
Why would I? Because I wanted to make money.
Okay.
And I know now that I say it out loud, and it's been several years since I've done that. I understand that you shouldn't have done it, but it was really difficult. And I think other traders find it difficult also. You want to make money. I love being in the market, and I was impatient to do something.
I see that a little different from the prop trading world. I think a lot of prop traders are impatient because they need to make money.
Oh, okay.
I think that most active traders, and I know Mitch was in that world for a little while. I think a lot of traders are impatient because they try and force trades because they need to make money as opposed to they want to make money.
Okay, all right. Yeah, I could definitely see that, needing as opposed to wanting, and just wanting to be in the market. I like trading, so I wanted to find something. Okay, I could definitely see that. So let's see what people are saying. I started getting disciplined when, you blew up a $425,000 account. Ouch.
Wow.
Talk about psychology. Save from when you enter to when you exit, if not taken out by a stop.
So trade management psychology.
Okay.
Let me type that in here.
Right. So, in other words, Al, you've already made some money, and you're afraid of losing the little money you've made. So you're gonna exit early because you've already made. Do you know why? I think that's part of the fear, and I think that's part of the not having the self-confidence. So what I would suggest, and see, I don't know what Pete thinks about this, if you want to get out of the trade because you've already made some, get out of some of it. Take some profit. You've made some profit on it, and let the rest of it go. What do you think there, Pete?
I think that there's 2 stages. Well, actually, maybe 3. The first stage is when you're still trying to figure it out and what you want to do. Then the second stage is you have a trading strategy, and I maybe I'm not answering this the right way, Al, but I'll give you the way I see that. The second stage, and let's call this somebody, and I'm going to define an inexperienced trader as anybody who's not past break even, and I'm purposely doing it that way because you will be amazed at how many people that have been trading 10 years that consider themselves experienced traders who aren't making a dime. So I want to make it, and again, I just want to be very clear on who I'm terming an inexperienced trader, because you could speak trading like you know every single word in the book that was ever written on trading, but you don't make any money. So I'm going to define that second stage as somebody who's inexperienced. You get to the point now where you have your strategy and you're starting to believe in your strategy. An inexperienced trader at that point usually gets more upset about losing trades, but they still have a strategy. When you get past that stage and your biggest concern is not so much losing trades, but you are more concerned with you're not holding good trades longer. When you get to that second stage, the actual trade management part of it is not as stressful or as confusing, because at that point you're like, well, I believe in my strategy. I just need to do what I'm supposed to do all the time. And over a lot of trades, it will work out. So when you find yourself getting to the point that individual losses don't matter because you know your strategy works and you could follow it, and over time you can make money. So essentially you believe you could make money, which, really, to put that into words, you get to the point where you expect to make money because you have a plan and you know you can follow it. Then the psychology of a trade management is, I don't care if I get stopped out, or I don't care if I have to scale back, because you're not really doing anything other than managing risk until a couple of trades work out or until they don't. So at that point, you're really nothing more than a risk manager of your strategy, which you believe in. So the psychology of managing trades, and this was, for me, this was really interesting, because when I really internally believed this, it was, Marion, I'm not even exaggerating, it was like a light switch that all of a sudden I never cared about a trading loss anymore, because I believed I could make money, because I believed I had a good strategy, and I believed I can follow it. And
right. I think that's self-confidence. And I think that's what's really hard to gain at first. Don't you? The self-confidence that overall you're going to make money and your trades are going to work.
Yeah, you have to believe you could make money.
Right.
And that comes from, you believe your strategy works, you believe it works over time, and you believe that you will follow it over time. When you have those three beliefs going into trading, it doesn't matter what happens in the market, quite honestly, because it's just one trade out of 100 you're going to make this month. And you just let the chips fall where they are. Because whenever I'm in a position, Alan, I'm managing a trade, I'm literally saying, all right, I'm accepting risk based on what I said. If it works out, great. If it doesn't, that's great too. And then you get to the point where you're like, oh, look, I don't know if it's going to be the first, third, seventh, and ninth trade that are going to be profitable, but I have a pretty good idea that over 10, it's going to work out if I do what I'm supposed to. So when you take all of that pressure off of every single trade individually needing to work, and the psychology of managing it, it just becomes so liberating in your trading, because now you're like, well, each trade doesn't matter. It's what I do over time, as long as I follow my rules.
I think that's really hard at first, because a lot of people read these books and some people have no winning trades. And let me tell you, I've been trading since 1979 and I still have losing days. Not only losing trades, but losing days. And until people get to understand that anybody who tells you they don't have losing trades, they're lying to you or lying to themselves, because they do. But you have to get over that and say, listen, I had a great idea and it didn't work out. And go on to the next one and leave it go, because it'll erode your self-confidence, and then you won't be able to hold those trades, the good trades.
Yep. For me, everything changed for me when I started to see everything from a probability perspective, and then it was just a question of me following my plan. Now, don't get me wrong, you're right. I mean, people probably sometimes do believe that there aren't losing trades from the people that are talking about the trades. That's total BS. I mean, and that's another thing. Like, what's your winning percentage? Nothing drives me more batty than what my winning. I don't care. Did I make money today? Could I have managed trades better sometimes? Absolutely. Absolutely, but I have losing trades. Just like I don't even care about the losing trades. If you believe you can make money, it's nothing more than running your business. Some days you go in, you turn the lights on, you butter the rolls, you make the bacon, you make the egg sandwiches. Some days you break even. Some days somebody comes in for a catering. It's the same thing. You're running a trading business.
Right, and some days your oven goes off and then you have to go buy a new one, and now you're down money on the day because you didn't possibly make that much. But it was part of the business. Maybe this is where we go into, how many of you guys have trading journals? How you write down your thoughts, you write down what you're doing, you write down the trades you were looking at, and even if ones didn't work out, but there's still ones to keep on your list, because someday they will. They might be consolidating at this time, but they will be a great trade one day. What do you think? Do you want to go into that, Pete?
Yeah, I think there's a couple of, it's interesting, because I actually recently had a conversation with somebody who's an experienced trader about a trading journal, and his version of a trading journal was his game plan. So we actually were talking about the same thing, but differently. To me, a trading journal is, you're obviously going to put in there the trade you made and whether or not you made money or not. But to me, a trading journal is by far the most valuable book you will ever read, because you want to put in there, how do I improve? You're journaling your journey as a trader to pay attention to what's working, what's not working, why it is or isn't working, so you could really make a big list of what doesn't work for you, and then get to the point where that really crystallizes your trading plan, and you say, no, based on how I've traded the last 6 months and being brutally honest with myself, this works, this doesn't work. I got to do a lot more of that and take the other stuff off of my list. And then you take the next step, Marion, which, as you said, you start journaling and keeping track of stocks from day to day that, maybe it didn't trigger today, tomorrow, or the next day. Like, we've had quite a few of those stocks. I mean, the last couple of weeks, we've had so many stocks that have been in the game plan meeting that were like, not yet, not yet, not yet. Oh, there it goes. But you have to keep them. That should be the first stocks you go to before you even look for new ones.
Right. So see, I guess my journal is a little more detailed because I do keep track of all of that. I keep track of the ones I was watching, and and I take some off if I see they aren't keeping up to what I had expected them to do, or ones that are just hanging in that I know I want to make sure I watch the next day, and I can't remember them all.
Oh, absolutely. That's a big thing too. If you believe that you're going to remember something at 4:30 in the afternoon, especially that you were thinking at 9:40 in the morning. See, my version of a trading journal, maybe this might be because I spent so many years in the proprietary trading industry, and I literally was like a psychologist to a lot of people. You need to learn from your own experience, and that's why I'm a little more diehard on your trading journal, is where you're going to learn from what you're actually doing if you're keeping it diligently. Because I could tell you flat out from my own experience, like, I would write my journal all week, and then I'd go read it on Saturday, and like some of the stuff that you write when it's fresh in your head is just amazing. You're like, I can't believe I wrote. Yeah, I understand I'm shorting a stock that's going straight up, but I'm going to do it. Stop,
Right.
So maybe we're seeing it just from a little different perspective. I'm seeing it from the perspective of using a journal as a way to document what you're doing so you can improve.
Okay, yeah, I guess it's also because we came out of two different worlds of trading.
Yeah, exactly. Somebody typed in, I think it was Anish, I'm impatient to exit the market, and I find it hard to stick to the plan. I think we covered that a little bit.
Right.
With actually making a commitment to one and then trusting it over a couple of months. I think a minimum of 3 months. Let's see. I'm going to type in. I'll put Al's most recent one in here. This way it shows up on the video later. So the fear of it going against you. So I guess this is tied up to the other part of his question there. But this kind of ties back to what Joan had said before about fear. You should never fear something happening. What you should fear is if you're not prepared for it. I don't know if I can explain that any other way. What do you think?
Fear of it going against you. Right. Again, I think that goes back to the self-confidence in your plan, and I think so much of it has to do with your game plan itself. Because in the morning, I can have maybe 50 ideas, and I start ticking them off like no good, no good, no good, because either I can't make a lot of money with them, I don't think they're going very far, and that's it. If you have just your game plan of ones that you have more confidence in the probability of them making money, you can hold them longer. If I have a stock that my probability is real low that I can make money in, you're right, I'm going to get out of it because I don't have the self-confidence in it. So game planning, I think, is probably one of the best skills a trader can learn, because it's what's going to give you the self-confidence to hold the trade.
Right, because you did all the work to put it in.
You didn't do your work at 10 o'clock when the Under Armour went through its resistance. You did your homework the morning or the night before, and you know where the next resistance is, and you know where you can get out of it. Not like, oh my gosh, now what do I do? You have to know where you're getting out before you even get in. And if you don't know where you're getting out, then it's terrible, because you're like going, oh my God, is this going higher? You don't know where resistance is. You don't know what the history of the stock is. So I think so much of this boils down to having the right game plan in the morning and having the right. I don't have 100 stocks on my game plan every morning because I've taken three-quarters of them off.
I just want to comment very quickly on and the fear of it going against you. First, I'll say that everybody's gone. That's happened to everybody. But to really work through this being an issue for you, what you should really fear is you don't trust whether you trust yourself or not to do what you're supposed to. And the way we mentioned this briefly in the game plan meetings in the morning is, we essentially say you must have if-then scenarios, and the more clear your if-then scenarios of if it does this, then it does this, if it constantly be going through your head, so you're always prepared no matter what when something happens. You can't let something like that happen out of the blue that you're not ready for. You must have, you must be prepared no matter what for anything. And again, don't type in and be like, well, what if a news story comes out that nobody expected? That's not what we're talking about.
Right. You know what, Pete? Remember that Tesla trade that I did, and I had a lot of what if thens in that. If it stocks does this, then I'll do this. If it does this, I'll do this. We can send that out to, is that Al, and see to understand
that sounds good.
The mental thought behind it. Al, what I'll do, and like I had written a anatomy of a trade, I guess it was maybe last week or the week before, and showed it to Pete. I'm in a trade and I say, okay, if it does this, then I'm going to do this. If it does this, I'll do this. If it does this, I'll do this. So I have actually 3 ifs then in my head already as soon as I got into the trade. So I knew what I was going to do. It didn't go halfway up and me go, oh my gosh, now what do I do? It hasn't done if it did one of the 3 things I said it was going to do, then I knew my action. So if you can do that ahead of time and you have your game plan, then I think it makes trading so much easier and you don't get that angst.
I want to type one more in here,
okay,
which I think is kind of cool. A frustration of knowing when an adjustment should or should not be made on my position. Yeah, it seemed like we had a little bit of internet issue there for a second.
Oh.
That's all right. That's all right. I can't do anything about it. So knowing when an adjustment should or should not be made in my position. And this can actually be taken both sides, against you or in your favor.
Right.
And
that's actually a really interesting question.
Yeah. And I can understand why it's a frustration.
Right.
I would think that trades moving against you, they're pretty easy to understand. It's either working out or it's not. You get into a trade and it's usually very cut and dry of, that's my stop loss and that's where I'm getting out, or at least that's where I'm scaling back, or, whatever it happens to be. I think the adjustments when you should or shouldn't and are in your favor. Should I add to a position? Should I be scaling out of a position? Should I do nothing but hold it until it hits my target? I think the easier way to deal with that is, and I say easier in a way that the answer is easy, but it's not easy to do. So I just want to make that clear. Is you need a checklist to tell you when more of the market is doing the same thing, so you can define when you should or shouldn't be a little aggressive. So in other words, let's say the Dow or the spiders are in a really slow grinding uptrend higher today. All 3 of the major indices are doing the same thing. Let's say you're trading Citigroup and all 5, 6, or 7 other major stocks are doing the same thing. And again, this gets back to strategy. If everything is doing what it's supposed to do, you can probably adjust to where you're adding or holding a little bit longer or putting on more positions. But as you work your way away from the perfect trade, that will also dictate how you're going to adjust to the trade. And something as simple as, should I be getting out into momentum versus should I be looking to add on the next pause? So if you believe a stock is slowing down, you should already be recognizing, based on a lot of things that we just discussed, well, the market's very choppy, it's all over the place, and the stock traded very well. Even if I'm not getting out, maybe I should at least move up my trailing stop. And if I get stopped out, not a big deal because the market's a mess today. Something like that. So adjust. It's interesting because this is a really complex question, Marion. It's like basically saying, well, when I get on the highway, how do I know when to change my speed? And
I actually think that's a good point Pete brought up, is to watch the general market And if the market is weak or apathetic, then it's probably not a good time to add, even if it's a good trade, because so often, I can't remember what the percentage of the stocks that are actually somewhat affected by the swing in the market every day is really high. So if it's a good day, you've got an edge. If it's a bad day, the edge is taken away from you.
Well, I think that gets back to the very first question is you absolutely need to commit to something. If you don't have an edge that you say this is what something means to me, then everything looks the same. So, and the reason I keep bringing that up is you have to know in your mind what awesome looks like so that you know what everything not awesome looks like, so then you could make your adjustments. If everything is the same opportunity to you every single day, that means you have no filter for what a great trade looks like.
Right, I agree with you.
All right, I got one more here. A little spelling mistake here, but distilling a vast amount of knowledge down to what is actually needed to structure a trading plan appropriate for my psychology. Well, first of all, I think only putting psychology in there is wrong. That's definitely one part of it, but structuring a trading plan has to be built on your trading experience, the amount of time you can sit in front of a room, your risk tolerance, how much capital you're actually bringing to the market. Are you going to be a swing trader or a day trader? And then you even take that a step further. Well, if I am not going to be able to sit in front of a machine all day, or do I want to swing trade? Do I want to swing trade options because I don't want to watch every tick up and down? I want to know my defined risk, that kind of stuff. So this really comes down to do the work. If you look, I'll be the first to tell you I have hundreds of trading books, but it really, if you look at our screens, we talk about this all the time, Marion. The screen setups are very, very simple, very simple.
And actually, maybe that's what this person is getting at. To structure your trading plan, I'm not sure if it's your trading plan or what you're going to look at. Are you looking at every single indicator that's out there? There's actually more than 100 indicators out there that you can watch in a given day. I do think that paralyzes traders. If you can get down to the few that you can translate into your knowledge of what the stock will do. I think I mentioned it earlier. Pete and I actually we never traded together, and we actually look at the same things every day. And it's very, very few. I have 5 things I look every day. I watch only the candlesticks, the 20 and 50-day moving average, the volume, and the volatility. That's all I look at. And I do well by that. Otherwise, too many different strategies and too many different indicators they'll totally confuse you. I've tried looking at every single one of them, and some of them make some sense, but then they negate another one, and I end up doing nothing.
I got to the point where I was watching too many indicators, and I found it was difficult for me to make a definitive decision. I wasn't confident with saying, well, I see a divergence in stochastics, but the something else is going up and something else is going sideways, and I'm looking at the same thing 3 different ways, and I'm like, all right, what am I supposed to do?
Right, exactly.
All right, so the next one we have here, we touched on this a little bit in a previous meeting, but it's in reference to level 2 in context, and I like the way Al worded here. He specifically said its importance to today's trading, because obviously a few years ago it meant a lot more than it does today. The way that we've discussed it a few times in the morning meetings, we talked about the difference between at what point do you drop down and look at something other than a chart. And myself personally, I very rarely go below a 5-minute chart. At that point, if I'm dropping below a 5-minute chart, it means that I'm really, really trying to fine-tune an entry. Level 2 trading and reading time and sales is a dramatically different business than it was, let's even say 10 years ago. I don't think that well, obviously it's also relative to your holding time. If you're scalping, it probably means a little bit more, and I put the emphasis on a little bit. But if you're intraday position trading or swing trading, it's not really relevant at all, quite honestly, because then you're not. I'm not saying you're not going to want to get out to the penny, but It's not as relevant as it used to be. And if you find yourself going all the way down to level two, I hope it's only to fine tune an entry as opposed to looking at a big bid or a big offer and saying, "Ooh, there's Goldman Sachs is on the bid. I should be buying stock."
I agree with you. I think we talked about this the other day in our room. And I did look at level two that day. It was when I was trading Netflix, and I was trying to get down to where I was getting in, and where I was getting into another level. And that's the only reason I used it. I rarely use it.
All right, here's an interesting one that I know that we've all experienced at one time. Better emotional control. What would you say about that one?
Better emotional control. Again, it's so hard because we're humans, and so emotions are part of who we are. But I say the two biggest emotions that can kill you are elation when you think you can do no wrong, and despair when you're, oh my God, I've just lost so much money, I need to make more. And if those start overtaking you, you need to walk away.
I know personally too. Sometimes you have to make sure that you're conscious of whether or not you're trading during an emotional, personal experience. We've all had the times where there's stuff going on in our lives outside of trading. We have to recognize and actually have that in our trading plan to recognize if that's happening and pull away from the markets. I actually have a friend who's going through some emotional stuff personally right now, and the advice I keep giving him, I'm like, God, don't risk money. It's going to be the most expensive psychotherapy you've ever had in your life, because you're mad at something else that's going on in your life, and you're placing random angry trades that you would never do. So you have to recognize first outside of the market, make sure that your trading can be challenging enough if everything's okay. But if you have stuff going on outside the market that's emotionally draining, you have to be on top of that as well. But from a little bit different perspective, and I think it's actually pretty cool, Marion, that we are admitting that we're coming to it from a little bit different perspective. I always go back to there's the emotion of being angry that you lost money on a trade, and then there's the emotion of having an opinion on a stock and not admitting it's not working out. I was finally able to get over being angry about trades not working out when I finally believed I could make money, which also translates into flawlessly taking losses. I will tell you flat out, and we discussed this a little bit before. For me personally, the larger losing trades were emotional attachments to the outcome, and whether one, it was whether I needed to make the money, or number two, I just was so under the impression that I was right and the market was wrong. I held on to trades too long. So once you get over, you believe that you could make money, you don't get as angry about trades that don't work out. The next step is just preventing that big blow up, and that's when you really need to be honest and just be really disciplined on taking losses.
Right, exactly. I agree.
Let's see. We're going to end it with this last one here. And I think this is right in line with everything else we've been talking about, but very general statement there for what is your biggest frustration. And they typed in uncertainty and risk. And I actually think that they're two different categories. What do you think?
Uncertainty and risk.
As far as relating them to frustrations.
Yeah, the uncertainty is really kind of what we've talked about before. Uncertainty to get in, uncertainty where you get out. And I guess I probably sound like a broken record here with game planning, but the uncertainty will get better, I promise, if you have a game plan. If you can really sit down the night before, the morning before, don't wake up at 9 o'clock and decide to go start to trade at 9:30. Get up a little bit earlier. We have a free in the trading blog. You can go in every morning, and I've done half the work for you. Just go and look for whatever says morning news with my name on it. And I'll tell you all the upgrades, the downgrades, what a kind of a recap of what the market is doing at that moment. Know what the market's doing. Know what news is out on any of the stocks you plan on trading. And a lot of the uncertainty will go away.
Yeah, I think uncertainty goes away when you actually feel prepared, and you have to let go of the fact that you're not going to predict the market. As much as anybody on television will tell you that they're making a call or we're making a call, the fact of the matter is nobody knows what's going to happen next, but you do get to the point where you're confident that your probabilities are going to play out.
Right, right. And I know it probably people are like, yeah, sure, but it does help. It helps with the confidence.
We'll end this on one last question, and I think this is relatively easy to discuss here because I know everybody wants to get back to the market as well. A question on stock selection. Being in a $100 stock, moving $3, and a $15 stock that can move $1. Stock selection has to be a part of your trading plan. In other words, you have to go into the market saying, which fight am I capable of picking? And, we talked about this a little bit at the beginning of the meeting today, Marion, with Netflix. It's exciting to watch a Netflix or, whatever stock happens to be moving around like that, but you have to be having your game plan that you're comfortable with wider swings in exchange for what could potentially be bigger profits. But, you can even take that down a tone because even before you get to that point, you should, regardless if it's a $15 stock or a $100 stock, you should know before the trade how much you're comfortable risking per trade. So if you're willing to risk $500 per trade, then you just adjust your share size for the more volatile / expensive stock down because it's a more volatile stock that can move more, or you adjust your share size up if it's only a $15 stock. But what's not changing is the dollar amount you're risking. It's the same $500. It's just a question of how you're risking that $500 in the market at that moment based on the volatility. So I think that was a pretty good first meeting. What do you think?
Yeah. What do you guys think? Of course, we think it's great. We're the ones doing it.
Exactly.
Did things make sense? Did you guys get anything out of it? Would you like to do it again?
Well, I think we could definitely put them on the schedule. Just a question of how often, Marion.
Right, exactly.
I would think once every 2 weeks would be kind of cool.
Yeah, I'm good with that.
This way everybody can get it on their schedule, try and work it in. I love these types of meetings because they're really coming from what everybody wants to learn. It's not us just saying, hey, we're going to teach you something today, and you have no choice but to listen. These are when they're interactive like this, I think they're a lot more fun.
And we've made so many mistakes. Like I said, I've been trading for years and years, and I would just like if people would learn from what I did wrong, and you don't have to do it, then you don't have to learn, or just help you through like the rough spots to trading, because it really is a great way of making money and a great career if this is what you want to do.
So we got a quote here from Mitch ending the meeting. Definitely having criteria one way or the other. I agree 100%. There's always the balance between profit potential and liquidity, and every trader needs to experience that for themselves. You need to say how much profit potential do I want to go after, and how much liquidity and institutional sponsorship do I want to have in the stock. All right, everybody. We'll let everybody get back to their day. Excellent turnout today. Very much appreciate everybody coming back. We will post this live to the YouTube channel at the end of the day. Might have to pull out that little section there where we lost the internet for a second.
Right.
But I will make sure that it's posted so anybody can watch, which is kind of why I did this thing with the PowerPoint, so you can literally fast forward to the question that you wanted to make sure that we covered, which I think it's easier to do that way.
And if you want to join us in the morning, don't you have like a free couple of weeks or something, Pete, that they can come in and just see what we do, and just to see if then you can maybe get the idea of what game planning is, and you can do it for yourself. You can join us, or you can do it on your own, but then at least you'll know how to game plan. Maybe if it's different, that we do it differently than what your idea of what game planning is. But it's free to come in there for a couple of weeks. So come join us.
Yep. I'll make sure what I'll do, Mary, is I'll post this video to the blog, and I'll put a link underneath the video to start a trial.
Yeah, that would be great.
Okay. Have a great day, everybody.
All right, guys. Thanks for coming. Bye.
Bye-bye.